Most people think of debt in black and white. You either have it or you don't. But the truth is, debt works more like a ladder, with levels that can either drag you deeper into financial stress or help you climb faster toward wealth. And here's the scary part. Most beginners don't even know which level they're standing on. In this video, I'm going to walk you through the 7 levels of debt, from the most destructive to the most strategic, and show you what it means for your investing journey. Level 1, the debt spiral. This is the absolute rock bottom of debt. Payday loans, loan sharks, or juggling multiple high-interest credit cards just to stay afloat. It usually starts with a small emergency. Your car breaks down, rent is due, or you're short on cash before payday. The lender makes it sound easy. Borrow now, pay later. But what they don't say is that interest rates can range anywhere from 30% to over 400% a year. Once you're in, it feels impossible to get out. You're paying off old debt with new debt, and every paycheck disappears the moment it arrives. For investors, this is a nightmare stage, because you're not just missing out on compounding, you're compounding in reverse. Every dollar that could have been invested in stocks or ETFs is already promised to someone else. The spiral keeps pulling you down until you break free. Level 2, toxic consumer debt. This is where debt stops looking like an emergency and starts looking like a lifestyle. Instead of payday loans, it's credit cards and buy now, pay later apps. You're no longer borrowing to fix the car or pay rent. You're borrowing to upgrade your phone, book a vacation, or cover takeout when you're tired of cooking. On the surface, it feels harmless. Everyone around you uses credit cards, right? But here's the trap, the interest. Miss just one payment, and suddenly that $1,000 vacation isn't $1,000 anymore. It's $1,200, then $1,500, and it keeps climbing. Unlike investing, where compound interest builds your wealth, here compound interest builds your debt. It works against you. You're buying things you want now and telling yourself you'll start investing later. But later never comes. Your credit card bill grows, your savings shrink, and your ability to buy stocks, ETFs, or even save for an emergency fund is delayed year after year. This level doesn't just cost you money, it costs you time. And time is the one thing investors can't buy back. Level 3, unsecured personal loans. At this level, debt looks more official. Instead of swiping a card at the store, you're taking out personal loans from a bank or signing up for buy now, pay later programs that split your payments into neat monthly chunks. It feels safer and more structured, but there's a hidden danger. These loans are unsecured, meaning there's no asset backing them. Because lenders carry more risk, they charge you higher interest rates, often 10% to 25% or more. The psychology here is tricky. Since the payments are fixed and predictable, it gives people the illusion of control. You tell yourself, I can manage this, it's just $300 a month. But over time, those monthly payments add up and squeeze your budget. The money that could have gone into your first stock portfolio, an index fund, or even just building a safety net is tied up in paying off yesterday's purchases. Unlike maxing out a credit card, you're making regular payments on time. But in reality, you're still stuck in a cycle where your cash flow is locked away, and the stock market keeps moving without you. Every year you delay investing, you lose out on compounding gains that could have worked in your favor. Unsecured loans might keep you comfortable, but they keep you from building wealth. Level 4, over-leveraged student or car loans. At this stage, debt starts to feel normal. Almost everyone around you has student loans or a car loan, so it doesn't seem dangerous. But the real problem comes when you borrow far more than your income can realistically support. Think about it. Taking on $60,000 in student loans for a degree that only leads to a $35,000 salary isn't an investment. It's a financial anchor. Or financing a $50,000 car when your yearly income is $40,000. The shiny new degree or the car in your driveway might feel like progress, but in reality, you've chained yourself to years of repayments. The danger here is subtle but devastating. Fixed payments on loans eat up cash flow before you even see it. That means less money to invest, fewer contributions to retirement accounts, and a late start on compounding, which is the single most valuable advantage beginner investors have. By the time people in this stage feel ready to invest, they've already lost 5, 10, or even 20 years of potential growth. Over-leveraging isn't just about numbers on paper, it's about opportunity cost. The longer your money is tied up, paying for depreciating assets or degrees that don't pay off, the less time it has to work for you in the market. Level 5, manage consumer debt. On the surface, this level looks safe. You use credit cards, Maybe a small personal loan, but you pay on time, avoid late fees, and keep your credit score in good shape. Compared to levels 1 through 4, it feels like you've figured debt out. But here's the problem. Even when it's managed, consumer debt doesn't help you grow. At best, it keeps you comfortable. At worst, it slows down your financial progress. You're still spending money on interest, annual card fees, or monthly repayments that don't add any value to your future. Every dollar going toward debt is a dollar that isn't compounding in the market. You're not panicking about bills anymore and you've avoided the spiral. But staying here means you're standing still while other people are building wealth. The difference between paying down debt and investing early can add up to hundreds of thousands of dollars over a lifetime. Managed debt is better than toxic debt, but it's still holding you back. Level 6, productive debt. This is where the story finally starts to shift. At this level, debt isn't about buying luxuries or covering shortfalls. It's about investing in something that can actually improve your financial future. Think of a low-interest student loan that leads to a career doubling your income, or a car loan for a vehicle that you need to commute to a higher-paying job. The key difference here is return on investment. The debt itself costs money, but it enables you to earn more than you could have without it. For example, a $20,000 student loan that unlocks a $20,000 salary increase pays itself back quickly, and then continues paying you for life. In the investing world, this is similar to using margin the right way, only borrowing when the upside is greater than the cost. Instead of seeing debt only as a burden, you start to recognize it as a tool. But, and this is critical, it only works if you're disciplined. Productive debt is still debt. If you overborrow or if the investment doesn't pay off, it can easily drag you back down the ladder. Used correctly though, it can be the bridge that gets you from surviving to actually investing. Level 7, leverage wealth. This is the stage where debt stops being a burden and becomes a deliberate strategy. Instead of borrowing for consumption, you borrow to multiply your wealth. Mortgages on rental properties, business loans to expand, or even carefully managed margin in your brokerage account all fall into this category. Here, every dollar of debt is tied to an asset designed to generate more money than it costs to borrow. The power of this level is leverage. Let's say you buy a rental property with a mortgage. You're not just paying down a loan. Your tenants are covering most of it while the property itself appreciates in value. Or imagine taking a business loan. That borrowed capital allows you to hire, scale, and earn profits that would have taken years without it. In investing, the principle is the same. Leverage magnifies returns. But leverage is a double-edged sword. If the asset performs well, your wealth grows exponentially. If it performs poorly, losses hit harder and faster. That's why only disciplined investors thrive here. They know how to manage risk, diversify, and never overextend. So now you know the 7 levels of debt, from the traps that destroy wealth to the leverage that can actually build it. The next step is learning how to put your money to work once you've broken free from the wrong kinds of debt. That's exactly what I cover in my free investing masterclass. Inside, I'll walk you through everything. It's 100% free and you can watch it right now using the link below. I'll see you inside.